to Tradfi and Bitcoin Club. So today we would be discussing the rise of Bitcoin stocks and bonds. So this is like why Bitcoin stocks and bonds are rising, why new Bitcoin treasuries are setting up every week, every day, and why are they going up, and why is market valuing them so much, and are they good for Bitcoin, and yeah, everything like that. So most probably we will do this thing in parts. I don't think we could cover this thing in one go. So this article is written by Lynn Alden. She is also the writer of Broken Money, and also she runs a fund from Ego Death Capital. She is a general partner there. Recently, they have raised 100 million of new fund today only to invest in Bitcoin, Bitcoin related, Bitcoin only and Bitcoin related startups. And yeah, so this is a pretty deep article, which is like very informative and very interesting to me. So yeah, let's start. So for the first part, I think we could cover it through the flow chart. And for the second part, I am thinking to like go into the lines and read each and every line. So let's see like how are we able to do that, and yeah. So the rise of Bitcoin stocks and bonds. Introduction. So as we all know, corporate Bitcoin treasuries are rising, and yeah, this is all started by MicroStrategy back in 2020, when they sold when they converted their 500 million of the fiat cash, which was sitting in their balance sheet, just idle, sitting around in the balance sheet. And one fine day, Michael Saylor uh, converted the fiat cash into the digital capital Bitcoin. And from that point in time, MicroStrategy was the only one who was doing it for most probably until 2024. And then some guys came in like Metaplanet, Similar Scientific, and all. And as you guys know, in past 6 months are like crazy for Bitcoin treasury companies. So if we go to bitcointreasuries.net, we can see like there are nearly 150 odd, nearly, yeah, 142 odd companies who have adopted Bitcoin as their treasury reserve asset. So yeah, the pace is kicking up, and we are seeing this pace going up. So yeah, this is the thing in the past six or a past year. In the last 1 year, Bitcoin treasuries are going, numbers are growing, and also they are performing also better. So why companies started to adopt Bitcoin as a treasury asset after 2023 and not before that? So there was a FASB update. So for the people who don't know FASB is Financial Accounting Standards Setting Board. So they set accounting standards wherein they first Bitcoin was not allowed to be reported at a fair market value. It was reported at cost. So basically, whatever cost you have acquired, and lower of cost. So, for example, strategy acquired Bitcoin at, for example, let's say $30,000 or 15, $20,000. So even if Bitcoin's price has risen through, like currently it's around 109 or 108K US dollars. Then also, before this FASB update, um, companies have to report Bitcoin uh, to their lower of cost or market value. Like, so even if Bitcoin was trading at 100K, strategy was reporting at the value like lower 15,000, which was the bear market low. So they were reporting Bitcoin's value at $15,000 value. So after this FASB update, what happened is like companies were allowed to report Bitcoin at its fair market value, because Bitcoin's market is pretty liquid and it's freely traded. So it made sense to change this rule and convert it into fair market value rule from the lower of cost or market. So yeah, from that point in time, we have seen some companies like Metaplanet and some were the next guys to adopt Bitcoin in their balance sheets, and some miners also in US like Mara and yeah. So in this article, we will explore like, is this trend good for Bitcoin or bad for Bitcoin? So this is the view of Lynn Alden, and we will also see like Bitcoin, like some people see Bitcoin as a medium of exchange, or and some people see it as store of value. So we will also deep dive into that thing. So for now, let's come to why Bitcoin stocks and bonds. So reason one is capital with mandate. Now, what's capital with mandate? So I think I have one. Yesterday, Michael Saylor launched ATM on Stride. So Stride is one of the preferred instrument which they have recently launched. So in that presentation, I found this thing wherein yeah, just a minute, I am opening this. Yeah. So are you able to see this one? 97% of institutional capital is mandated to equity and credit. Um, my screen is visible, right?
Yes, it is visible.
Yeah. So what I was saying is that capital is mandated. So there are mutual funds or equity funds or exchange traded funds which have been mandated to invest in either equity or credit instruments like bonds. So when these managers of these funds, even if they are bullish on Bitcoin, they were not able to invest in Bitcoin, because like this institutional capital, only out of this 60 and 35, it comes to around 95 and rest 3, so 98. So 3 trillion is only commodities, and rest is like equity and credit, which is bonds. So this 3 trillion capital, out of this 3 trillion, here's a correction, it's 2.3 trillion, not billion. So 2.3 trillion in central banks primarily allocate to gold. So out of this 3 trillion, only 700 billion in private capital was allowed to invest in Bitcoin. So all of this which I am talking is taken from Saylor's yesterday's presentation, wherein he showed this thing. Um, so, as Joe Burnett is talking about this here, it clearly shows how Bitcoin treasury companies are meeting the market where it is, and by offering securities that align with how today's financial system is currently structured. In my opinion, most investors still don't truly understand Bitcoin, and most capital is passively flowing into almost everything but Bitcoin. Bitcoin treasury companies are issuing securities that redirect that capital flow. They are opening the waterfall from traditional assets into Bitcoin. So this is what I think, like whatever instruments, like in our earlier sessions when we were discussing about macro strategy, we had this thing. So MSTR convertible bonds, uh, they opened for the Bitcoin bullish managers who were in debt funds, and now they can invest in convertible bonds, which were giving like 0.75 times correlation of Bitcoin. Now they have preferred stocks, which here he says MSTR dividend and MSTR fixed. So we have preferred stocks, Strike, Stripe, and Stride in this case. And yeah, so this is how Bitcoin treasury companies are, like how Joe Burnett says, like they are opening the waterfall from traditional assets into Bitcoin. So this Strike, Stripe, and Stride, they are opening waterfall from this 60 trillion credit markets. So the capital which was stuck in here, which was investing in the US treasuries, which were not allowed to invest in Bitcoin, and which was like this credit markets is all US treasuries, corporate bonds, and everything like that. So this thing is being unlocked by Sailor through the Strike, Stripe, and Stride. So what is Strike, Stripe, and Stride? Strike is preferred stock, which is gonna 1/10 convertible to MSTR. Stripe is again preferred stock, um, which does not have any convertibility option to MSTR. And yeah, Stride is also one of the preferred stock, which is more into the junk bond market. Like Stride has a higher yield compared to Stripe. Also, there's one interesting thing in Stride is um, the dividend payment of Stride is non-cumulative in nature. So let's say, for example, Stride has to pay dividend this quarter, and we are in 2026 May. So most probably, I don't I mean, I am just hypothesizing it, like next year we might be in the beer market. So what happens to these dividend payments of Stride? So Stride dividend payments are non-cumulative in nature. What does that mean? Non-cumulative means dividends are non-cumulative. For example, if strategy wishes to skip a dividend this quarter, then they are allowed to skip. And next quarter, they will only pay dividends which are liable for next quarter and not for previous quarter, which doesn't happen in case of Strife. So in case of Strife, if they miss first quarter dividend, then they have to pay first quarter and second quarter dividend in the second quarter. So that is known as cumulative. And what I am talking about is non-cumulative. So all of these instruments like Strike, Stripe, and Stride, they are targeting 60 trillion of credit markets, and MSTR is targeting 35 trillion of equity market. So this is how Sailor is pulling, and all of these Bitcoin treasury companies are pulling this capital from equity and credit markets to Bitcoin. So this is what I was trying to explain is like capital with mandate. So this is how treasuries are converting the traditional capital to Bitcoin. So, trillions of managed capital, portfolio managers having strict mandates, only stocks. So, when we invest in a mutual fund or a exchange traded fund, the manager of that fund has a mandate where he is strictly asked to invest it in only stocks. For example, if there's a mutual fund which only invests in high growth IT stocks, then he has to only invest in IT stocks. He can't also invest in banks. So these mandates, what mandates mean is this. So when that portfolio manager has to invest in stocks, they are only allowed to invest in stocks and they cannot buy Bitcoin for certain funds. So how Bitcoin on balance sheets of company changes it. So as Lynn Alden also was managing a fund wherein back in 2020 wherein she was looking to invest in Bitcoin, but she wasn't allowed back then. So let us go to that example wherein she explains how difficult was it. So yeah, here. So she says, I will use myself as a tangible micro example of how a Bitcoin treasury company was useful for this purpose. I have been running a real money model portfolio for my free public newsletter since 2018. It lets readers keep track of my positions transparently. In early 2020, I strongly recommended Bitcoin as an investment in my research service and bought some myself. By extension, I wanted to add some Bitcoin exposure to my newsletter portfolio, but the brokerage I use for the portfolio offered no access to Bitcoin related securities at the time. I couldn't even buy GBDC for the model portfolio back then because it traded over the counter rather than on a major exchange. Fortunately, strategy known as MicroStrategy at that time added Bitcoin to its balance sheet in August 2020. That stock traded on the Nasdaq and my model portfolio brokerage could buy it. So with my various constraints for that particular portfolio, I was happy to buy MSTR for growth stock section to express my bullish view on Bitcoin. The portfolio has been long MSTR ever since and it's been great decision for nearly 5 years from now. So this is Lynn Alden comparing how it was a difficult situation for her, like she was not able to buy Bitcoin in her growth portfolio. So she bought MSTR back then, and from that point in time, MSTR has gave around 2,850 percentage returns, and Bitcoin has given 816% return, and S&P 500 is at 100. So like MSTR has has been a boon for Lynn Alden. Like she wasn't able to invest in Bitcoin although she was long on Bitcoin. So she wasn't even allowed to invest in GBDC. GBT was traded in as it was trading in over the counter exchange over the counter. So what is OTC? OTC is like it's not a primary exchange. So many brokers don't provide you to invest in OTCs directly. So in case of like if you want a real example, if you go on interactive brokers and try to invest in Metaplan and you can't buy MTPLF there because MTPLF trades on OTC desk. So this is a similar situation for Lynn back in 2020. She wasn't being able to invest in GBDC or GBTC also. So the let's continue this. The brokerage eventually added GBTC as a viable security and of course eventually added major spot Bitcoin ETFs when they became available. And yet I have continued to hold onto MSTR in that portfolio as well for the upcoming second reason described below. So this is the first part, like capital mandate, reason, capital mandate, capital with a mandate. So now let's come to corporations have ideal leverage. So till this point, does anybody have a doubt or any question? Feel free to ask.
Hey, can you share the URL of her newsletter portfolio you have?
Okay, I will share in the chat after the session.
Thanks.
Yeah. Anyone else? Okay. Let's continue. So while Alden continues to hold strategy even if ETFs are out there and she can invest directly in Bitcoin ETF. So beyond holding Bitcoin, buying with leverage makes sense. So publicly traded corporations access better leverage. For example, uh, if if let's read the article itself. Um, she explains it better. The basic strategy for a corporation to adopt Bitcoin as a treasury asset is just to hold some Bitcoin instead of cash equivalents. However, the earliest movers on this concept tend to have very high conviction about the idea. As a result, the trend has been not just to buy Bitcoin but to buy Bitcoin with leverage. And it happens to be the case that publicly traded operating corporations have access to better types of leverage than hedge funds and most other types of capital. Specifically, they have the ability to issue corporate bonds. Hedge funds and certain other pools of capital typically use margin loans. They borrow money and use it to buy more assets. But they risk having a margin call if the value of assets drops too low relative to the amount of money borrowed. A margin call can force the hedge fund to sell assets if they dip too much in price, even when they have a strong conviction that those assets will recover. To having to liquidate a good asset at its lows is a catastrophe. In contrast, corporation can issue bonds, often with multi-year durations. If they hold Bitcoin and the price dips, they don't have to sell prematurely. This gives them better ability to weather periods of volatility than entities that rely on margin loans. There are still bearish scenarios that could force corporations to liquidate, but those scenarios would involve a much longer bear market occurring, thus making them less likely. This type of longer duration corporate leverage is also usually better in the long run than leveraged ETFs since leveraged ETFs don't use long term debt. Their leverage resets daily and so volatility is often quite bad for them. Fidelity has a good article that breaks down the number with example. So what she is trying to explain is is like if a person is long on Bitcoin, he or she might be looking to invest in Bitcoin by taking some loan or by taking some leverage. So what point she is trying to make in here is like corporations get better deals when they take leverage rather than hedge funds or individuals. So corporation can issue bonds but individuals can't, and even hedge funds also can't. So that is the reason why hedge funds might get margin called if Bitcoin dips 50-60%. But this is not in the case of Bitcoin treasury companies, or more specifically in case of MicroStrategy and companies like MetaPlanet. So MicroStrategy currently it has a leverage of around 15 to 20% and Metaplanet has a leverage of less than 5% or than 2 or 3%. So if you want to check what is the leverage of Metaplanet right now, they have this site where they track their leverage. So debt outstanding is 163 million and Bitcoin NAV is 1.69 billion. So, and their market cap is trading around, what's the MNAV? Yeah, MNAV is 4.28. So 1.6 into 4, so 4.8 billion. So their market cap will be around 4.8 billion and they have debt outstanding of 163 million. So that debt is nearly uh, it's less than 5% or maybe less than 1% also. So this is how the treasury companies are taking debt, but they are like intelligently leveraging it, like the terms of their debt. That the debt which they raise is not callable. Like they can't get margin called if Bitcoin hits like previous bear market lows also. So in case of MicroStrategy, I know that number. For MicroStrategy, the number is, even if Bitcoin goes to 8,000 or 9,000 US dollars, then also MicroStrategy doesn't need to liquidate its Bitcoins. So this is how they have intelligently levered themselves with convertible bonds, with Strike, with Strife. So the, like here, as in Lin was explaining, corporations could issue multi-year corporate bonds. So the here she is explaining, in contrast corporation can issue bonds often with multi-year durations. So this is the main thing, like because of this multi-year durations, even if Bitcoin goes to 8,000 or 9,000 odd levels in the next upcoming bear market, then also strategy doesn't have any need to sell its Bitcoin, or strategy is not liable or obliged to sell its Bitcoin. They can simply sit in through the bear market and wait for the next phase of Bitcoin to rally. So this is how corporations are able to lever themselves, which we as individuals can't. Now she here is taking some examples of leveraged ETFs. So she is making a point in here, like why not to invest in 2 times leveraged ETF, which which promises us to give returns of 2 times of Bitcoin. So here she takes an example from Fidelity's article. So look at this chart. For example, leverage ETF resets daily. So what's happening in this leverage ETF is, like these ETFs resets daily and they target daily 2 times return, and not like a year after 2 times return. On a longer term they don't do it because it's like not possible, or it's very hard to outperform any asset on the like long term, especially when you are long on that asset. So here's an example. For example, on day zero, an asset is at $100 share price or $100 price, and same for the 2x leverage ETF. It is also at 100. Next day the asset goes 10% up, so ETF goes 2 times, like 20% up. So 100 becomes 110 for the asset, and for the 2x leverage long ETF it becomes 120. What happens if um, asset goes minus 10% the next day? It comes back to 99 and the leverage ETF comes back to 96. So if this cycle continues of plus 10% and minus 10%, then as you can see here, on the 10th day, the main asset on which this ETF is based it comes to 95, and the leveraged long asset comes to 81. So if the asset is highly volatile, investing in leverage ETF doesn't really make sense um, if you are in it for long term. If you are trading for short term, then it might make sense for some of you. But if you are in it for long term, it makes sense. So this is what Len is trying to explain here. In practice, the 2x leverage Bitcoin ETF B2 hasn't really outperformed Bitcoin since its inception. Despite Bitcoin having increased in price during that period, you would expect 2x leverage version to greatly outperform, but instead it mainly just added volatility without superior returns. So this B2, which is two times leveraged, like which is focused to give two times returns of Bitcoin, that is not able to do that. Now, why? This is because of this thing. As we all know, Bitcoin is highly volatile. So because of this volatility, B2 is not able to outperform Bitcoin by 2x. So as you can see here, um, even if we are taking twice as much of volatility or as we has performed only like both Bitcoin and B2, which in case is a 2x, two times leverage ETF, it has only outperformed Bitcoin by 3%. Like Bitcoin is 54% and B2 is 57%. So this doesn't make any sense, like because you are taking risk which is twice as volatile as Bitcoin and you have just outperformed it by 3%. It doesn't make any sense. And on the contrary, look at MSTR share price in that time period. MSTR is up 155% and Bitcoin is up 54%. So this is how, for example, if an investor who is looking to take some leverage on leveraged long position on Bitcoin, MSTR or some other Bitcoin treasury companies might make some sense in their portfolio, maybe 10% or 20% according to the risk appetite of a particular person. So MSTR really is making sense. Now come to the same is true when you look at long-term equity sectors like 2x leverage financial sector or energy sector. So here she is again trying to make a point wherein again the twice 2x lever DTF is not working. Like here, as you can see, the financial share sector ETF is 57% up, but on the same time period, the 2x lever DTF is just up 6%. And here is one more example of energy sector. Energy sector here is up 162%, and in the contrary, the pro shares ultra energy 2x lever DTF is like down minus 42%. So daily leverage is pretty bad unless you are a short term trader. Volatility hurts that type of leverage. So, however, having a long term duration debt attached to an asset does generally lead to the same problem. So she is trying to explain like this leveraged ETF do some options and all of that stuff to daily reset the leverage, but in the case of Bitcoin treasury companies or MSTR, they take longer duration debt attached to the asset, which doesn't generally lead to same problem. So it generally doesn't lead to same problem, but in some cases it might. So an appreciating asset with a multi-year duration debt attached to its powerful combination. Therefore, Bitcoin treasury companies are useful securities for high conviction Bitcoin bulls that want some reasonably safe leverage to juice the returns. So, how what Saylor says is like they are intelligently leveraging. So this is what she is trying to explain in here, like Bitcoin treasury companies are useful securities for high conviction Bitcoin bulls that want some reasonably safe leverage to juice the returns. So not everyone should take on leverage, but those who do will naturally want to do it in the most optimal way. So as we all know, some people are of the opinion like they just want Bitcoin in self custody, and there's absolutely no problem to hold Bitcoin in the self custody. Like whenever you take out Bitcoin from your self custody, that is that is risk. So whenever your Bitcoin is sitting in your self custody, that is zero risk. So when you take out Bitcoins from your self custody, you are taking risk, and if you are taking risk, you naturally want some better return as compared to your self custodied Bitcoin, or maybe you want to multiply your Bitcoin holdings in the future. You want to get some leverage and do some stuff. So what she is trying to explain in here is like most optimal way is not to invest in this levered long Bitcoin ETFs. The most optimal way is to go into the Bitcoin treasury companies and invest into these treasuries. So these treasuries are also um, building some products like in terms of risk profile, size, sector, jurisdiction, and so what does this mean? Risk profile. So for example, let's go back to the to this chart, and this is how a risk profile looks like. So for a person whose risk profile is to buy Bitcoin and sit with it, he is okay to buy spot Bitcoin ETFs. So instead of spot Bitcoin ETFs, he can buy directly self-custodied Bitcoin, but some of his fund might not be able to. The funds might be locked into some government schemes. So in the US, they have this IRA where their retirement where the retirement funds are locked in that IRA account. So they can't buy Bitcoins, self-custodied Bitcoin in that IRA accounts. So instead of buying Bitcoin on chain, they buy spot Bitcoin ETFs if they are okay with volatility of Bitcoin. But what if they are not okay with volatility of Bitcoin? They can buy in MSTR convertible bonds, and they can get 0.75 times correlation Bitcoin. And what if they are not okay with 0.75 times of leverage? Then they would go to preferred stocks like Strike and Stripe. The volatility which they the the correlation which they give is 0.5 times. So this is how treasury companies are turning the Bitcoin capital on their balance sheet uh, into the different structured products, which makes sense for different risk profiles of different investors in different jurisdiction and different sections of the markets. So it's a genuine market demand that is over time. Similarly, some of the securities offered by these corporations, such as the can offer Bitcoin price exposure with less volatility. So this is what I was trying to explain in here. Like these MSTR convertible bonds and preferred stocks can offer some uh, similar returns like 0.75 times of Bitcoin or zero point 0.5 times of Bitcoin. And according to risk profiles, investor can invest in them. While some investors may want that extra volatility, others may want less, and the range of available securities provide investors with specific type of exposure they want. So, as we took example of some less volatile guys investing in who are open to take less volatility, they invested in MSTR converts and preferred. But what about some people who are okay with more volatility? They can invest in MSTR equity, that is MSTR common stock. And also there are some other options like MSTX and offer two times MSTR equity, and MSTR options is the last option. Also, some other Bitcoin treasuries also fall in here, three times and five times of Bitcoins return, because they are currently uh, like just starting off. And yeah, so till here, if somebody has any doubt, um, we can we can open the doubts thing. And because I don't think we should start this today. Do corporations help or hurt Bitcoin's mission? So today, in the next session, we will go into this. Uh, do corporates hurt or help Bitcoin's mission? For today, I think we should stop here, and we should open the session for questions. Jatin, if you are there, we can stop recording.
Um, and can you? I still didn't get the argument that leveraged ETFs don't perform as good as uh, treasury company equities.
So, because these leverage ETFs are like they reset the leverage daily. So, as for example, in this chart. So, what if Bitcoin goes up and down 10%? Pretty like Bitcoin does this now and then. So after 10 days, if you can see, the expected 2x levered long ETF is at 81, and we started with 100. So this is the reason why levered ETF in the long run doesn't work. And the history also, like, even if we look at the historical charts, you can see this, like, levered long ETF is um, like underperforming Bitcoins in some cases, and in some cases it's just meeting Bitcoin returns. But in case of strategy, it's different. Like, strategy is up 155%, and Bitcoin is up 57%. So
So
because
basically,
because
because
yeah,
the leverage cuts both ways, and the long ETFs don't have any ways to cut the longs, cut the shorts. Correct.
they have ways to cut the longs and shorts, but what happens is they target 2x daily and not 2x in 1 year. This is the main reason
Okay.
why they aren't able to outperform Bitcoin or outperform other Bitcoin treasury companies.
Okay. Okay.
So treasury companies have a target to outperform Bitcoin in the longer term. So in short term, it might underperform, but in the longer term, because they don't have to reset their options position daily, um, they don't need to. Like, for example, how MicroStrategy does it. MicroStrategy gives MSTR converts and preferred stocks to the people who are not okay with volatility, or uh, with some part of Bitcoin return and Bitcoin volatility, and transfer this volatility and return to MSTR equity, guys. So this is how MSTR and other treasury. But in case of levered long ETF, they just have reset it daily, and because they reset it daily, it doesn't happen like that way. This is the reason why these leveraged long ETF doesn't work in the long term. If like if you want to trade in a short term for weeks or for days, it might make sense, but in the long term, it doesn't.
Okay. Okay. And
Yeah.
one more thing that I have question is um, now Sailor is saying that he is targeting certain pools of capital that have mandates to invest in certain things and stuff like that. So my
Yeah.
question is, these investments or vehicles that have mandates, do they invest wherever they invest just because, like, do they actually go into the underlying business, or do they ever do value investing, or they just fulfill their primary objective is to fulfill their mandate's objective, and they invest in whatever instrument that gives them the best return, irrespective of what is the underlying business of the business underlying business of the investment.
First comes mandate. Like if a particular investment is out of their mandate, then they don't invest, even if that thing looks good. So, for example, Bitcoin, as Lynn Alden was explaining, um, she wasn't been able to invest in Bitcoin because of the mandate. Even if Bitcoin was looking promising in the longer term, she wasn't able to invest in that in Bitcoin, even in the GBDC. So yeah, first comes mandate, and then the other things come secondary.
Okay, got it.
So how Sailor is looking to target this credit credit markets, and credit markets is basically to strike and strike. So if you guys know banks, for example, banks have to maintain